European banks are quietly holding hundreds of billions of euros in loans that are unlikely to ever be fully repaid. These loans, known as non-performing loans, sit on balance sheets without making headlines or causing immediate panic. Yet they accumulate risk over time, creating a hidden vulnerability within the banking sector. As a PhD candidate in finance at the University of Athens, my research focuses on these non-performing loans in the European Union. Today, I'll provide an insider's explanation of what NPLs are, why they matter, which countries are most exposed, and what a realistic worst-case scenario could look like for European banking. While the system is stronger than it was in 2012, complacency remains dangerous. Let's explore why. As someone deeply involved in academic research on European banking, I bring a unique viewpoint to the topic of non-performing loans. Most finance channels only scratch the surface, but my work dives into the mechanics, the regulatory landscape, and the real risks these loans pose. Understanding NPLs is crucial for anyone interested in the stability of Europe's financial system. This video will break down the basics, highlight the countries most at risk, and examine the potential consequences if these loans continue to grow unchecked. We'll move beyond headlines and look at the facts, drawing on the latest research and real-world examples. Though European banks are in a much better position than they were during the 2012 crisis, complacency can be risky. The improvements in regulation, capital buffers, and risk management have made the system more resilient. However, the presence of large volumes of non-performing loans means that risks still linger beneath the surface. It's important to recognize that these risks can escalate quickly if economic conditions deteriorate. By understanding the nature of NPLs and their impact, we can better appreciate why vigilance is necessary, even in times of apparent stability. Start with the basics. What exactly is a non-performing loan? In banking terms, an NPL is a loan where the borrower has stopped making payments for 90 days or more. This is a critical threshold because it signals that the loan is no longer generating income for the bank and is unlikely to be repaid in full. The process begins with a loan being issued, followed by regular payments. If those payments are missed for 3 months, the loan is reclassified as non-performing. This classification has major implications for both the bank and the borrower. Visualize the life cycle of a loan. Imagine a simple timeline. A bank issues a loan, the borrower makes regular payments, and the loan performs as expected. This generates income for the bank and helps the borrower achieve their goals, such as buying a home or expanding a business. However, if the borrower encounters financial difficulties, like losing a job or facing higher interest rates, they may stop making payment. After 90 days of missed payments, the loan is officially classified as non-performing. This shift marks a turning point in the loan's life cycle and signals trouble for the bank. Consider a real-world scenario. You borrow 100,000 euros from a bank to buy an apartment. Each month you repay a portion of the principal plus interest. As long as you make payments, the loan is performing and the bank earns income. But if you lose your job, your business fails, or interest rates rise sharply, you might stop making payments. After 90 days without payment, your loan is reclassified as non-performing. This example illustrates how quickly a performing loan can become a problem for both the borrower and the bank. When a loan becomes non-performing, the bank loses the expected income stream. The regular payments that once contributed to the bank's profits disappear, creating a gap in revenue. This loss can be significant, especially if a large number of loans become non-performing at the same time. The bank must then find ways to compensate for the lost income, which may involve raising capital, cutting costs, or seeking new sources of revenue. The impact on the bank's financial health can be substantial, affecting its ability to lend and invest. Regulators require banks to set aside capital, known as provisions, as a buffer against expected losses from non-performing loans. These provisions act as a safety net, ensuring that banks have enough resources to absorb losses if borrowers fail to repay. The process of setting aside provisions reduces the bank's available capital, making it more difficult to lend or invest in new opportunities. This regulatory requirement is designed to protect the financial system, but it also places additional pressure on banks with high levels of NPLs. High levels of non-performing loans can restrict a bank's ability to lend. When banks are forced to set aside large provisions, they have less capital available for new loans. This can slow economic growth as businesses and individuals find it harder to access credit. The ripple effect extends beyond the bank, affecting the broader economy and potentially leading to higher unemployment, lower investment, and reduced consumer spending. Understanding this dynamic is key to appreciating the wider impact of NPLs. Non-performing loans are not evenly distributed across Europe. Some countries are more exposed than others, depending on their economic conditions, banking practices, and regulatory frameworks. Southern European countries such as Greece, Italy, and Spain have historically struggled with higher levels of NPLs. These countries faced severe economic downturns during the financial crisis, leading to a surge in non-performing loans. By contrast, Northern European countries generally have lower NPL ratios, reflecting stronger economies and more conservative lending practices. Let's take a closer look at country exposure. Greece remains one of the most affected countries, with NPL ratios far above the European average. Italy and Spain also face significant challenges, although their ratios have improved in recent years. The reasons for these differences include economic structure, regulatory enforcement, and historical lending practices. Understanding which countries are most exposed helps us identify where risks are concentrated and where potential crises could emerge. Economic downturns play a major role in the creation of non-performing loans. When economies contract, businesses struggle, unemployment rises, and borrowers find it harder to repay their debts. This leads to an increase in missed payments and ultimately more loans being classified as non-performing. The financial crisis of 2008 and the subsequent Eurozone crisis were key drivers of NPL growth in Southern Europe. Recovery has been slow, and the legacy of these downturns continues to affect bank balance sheets. Regulators across Europe have responded to the NPL challenge with a range of measures. These include stricter capital requirements, enhanced supervision, and incentives for banks to reduce their NPL portfolios. The European Central Bank has played a central role, pushing for greater transparency and faster resolution of problem loans. While progress has been made, the effectiveness of these measures varies by country and bank. Continued regulatory vigilance is essential to prevent future crises. One of the key regulatory tools is the capital buffer. Banks are required to hold extra capital to absorb losses from non-performing loans. This buffer protects the bank's solvency and ensures it can withstand shocks. However, maintaining large buffers can be costly, reducing profitability and limiting the bank's ability to grow. The balance between safety and growth is a constant challenge for European banks, especially those with high NPL ratio. Banks use various strategies to resolve non-performing loans. These include restructuring the loan terms, selling NPL portfolios to investors, and pursuing legal action against borrowers. Each strategy has its own risks and benefits. Restructuring can help borrowers get back on track, but it may not fully recover the loan. Selling NPLs transfers the risk to investors, often at a discount. Legal action can be costly and time-consuming. The choice of strategy depends on the bank's resources and the regulatory environment. Investors play a growing role in the resolution of non-performing loans. Specialized funds and asset managers purchase NPL portfolios from banks, hoping to profit by recovering more than they paid. This process helps banks clean up their balance sheets and focus on new lending. However, it also introduces new risks, as investors may be less patient or aggressive in pursuing repayment. The rise of NPL investors is reshaping the European banking landscape. Legal challenges can complicate the resolution of non-performing loans. Different countries have varying legal frameworks for debt recovery, foreclosure, and bankruptcy. In some cases, lengthy court processes delay the resolution, increasing costs and uncertainty. Banks must navigate these legal hurdles to recover as much as possible from non-performing loans. The complexity of legal systems is a major factor in the speed and effectiveness of NPL resolution. Economic recovery is essential for reducing non-performing loans. When economies grow, businesses prosper, and borrowers are better able to repay their debts. This leads to a decline in NPL ratios and strengthens bank balance sheets. Policymakers focus on stimulating growth, improving employment, and supporting sectors most affected by downturns. The link between economic health and NPLs is clear. A strong economy is the best defense against rising non-performing loans. Banks conduct stress tests to assess their ability to withstand shocks from rising non-performing loans. These tests simulate adverse scenarios, such as economic downturns or market disruptions, and measure the impact on bank capital and solvency. Regulators use stress testing to identify vulnerabilities and ensure banks are prepared for potential crises. The results guide policy decisions and help banks strengthen their risk management practices. What does a realistic worst-case scenario look like for European banking? If economic conditions deteriorate sharply, the volume of non-performing loans could surge. Banks would face mounting losses, reduced capital, and restricted lending. The ripple effects could spread across the economy, leading to higher unemployment and lower growth. Regulators would need to intervene, possibly with bailouts or emergency measures. While this scenario is unlikely, understanding the risks helps us prepare for potential challenges. History offers valuable lessons for managing non-performing loans. The 2012 European banking crisis was fueled by high levels of NPLs, weak regulation, and economic instability. Banks struggled to recover losses, and governments were forced to intervene. Since then, reforms have strengthened the system, but the risks remain. Learning from past crises helps policymakers and banks avoid repeating mistakes and build a more resilient financial sector. Current reforms focus on reducing non-performing loans and improving bank resilience. These include stricter lending standards, enhanced supervision, and incentives for banks to resolve NPLs quickly. The European Central Bank and national regulators work together to monitor progress and enforce compliance. While reforms have made a difference, continued vigilance is necessary to prevent future crises and ensure the stability of the banking system. The European banking system is stronger today than it was a decade ago. Improved regulation, higher capital buffers, and better risk management have reduced vulnerabilities. Banks are more transparent and regulators are more proactive. However, the presence of non-performing loans means that risks still exist. Maintaining strength requires ongoing effort, adaptation, and vigilance from all stakeholders. Complacency is one of the biggest risks facing European banks. When the system appears stable, it's easy to overlook hidden vulnerabilities. Non-performing loans can accumulate quietly, creating risks that only become apparent during downturns. Vigilance, regular stress testing, and proactive management are essential to prevent surprises and maintain stability. Recognizing the dangers of complacency is key to safeguarding the financial system. Data trends show that non-performing loan ratios have declined in many European countries since the crisis. This reflects improved economic conditions, stronger regulation, and better risk management. However, some countries still struggle with high NPL levels, and new risks can emerge if economic conditions worsen. Monitoring data trends helps banks and regulators identify emerging problems and respond effectively. Effective risk management is crucial for controlling non-performing loans. Banks use a variety of tools, including credit analysis, loan monitoring, and early intervention strategies. By identifying problems early, banks can take action to prevent loans from becoming non-performing. Strong risk management practices help maintain stability and protect the bank's financial health. Banks use early warning systems to detect signs of trouble before loans become non-performing. These systems monitor borrower behavior, payment patterns, and economic indicators. By identifying risks early, banks can intervene and help borrowers avoid default. Early warning systems are an important part of modern risk management and contribute to overall financial stability. Loan restructuring is a common strategy for dealing with non-performing loans. Banks may adjust the terms of the loan, reduce interest rates, or extend repayment periods to help borrowers get back on track. Restructuring can prevent default and recover some value for the bank. However, it's not always successful, and some loans may still become non-performing. The effectiveness of restructuring depends on the borrower's situation and the bank's resources. Banks often sell portfolios of non-performing loans to investors. This process transfers the risk to buyers who hope to recover more than they paid. Portfolio sales help banks clean up their balance sheets and focus on new lending. However, selling NPLs usually involves a discount, meaning the bank takes a loss. The market for NPL portfolios is growing, attracting specialized investors and asset managers. Asset management firms specialize in handling non-performing loans. They purchase NPL portfolios, manage recovery efforts, and seek to maximize returns. This industry has grown rapidly in Europe, driven by the need to resolve large volumes of problem loans. Asset managers use sophisticated techniques to recover value, including negotiation, restructuring, and legal action. Their involvement helps banks focus on core activities and reduces systemic risk. Regulatory oversight is essential for managing non-performing loans. Regulators monitor bank practices, enforce compliance, and set standards for NPL resolution. The European Central Bank and national authorities work together to ensure banks are following best practices. Oversight helps prevent excessive risk-taking and protects the stability of the financial system. Transparency is critical for managing non-performing loans. Banks must disclose their NPL ratios, resolution strategies, and progress in reducing problem loans. Transparency builds trust with investors, regulators, and the public. It also helps identify emerging risks and supports effective decision-making. The push for greater transparency is a key part of ongoing reforms in European banking. Investor confidence depends on the management of non-performing loans. When banks are transparent and proactive in resolving NPLs, investors are more likely to trust the system. Confidence supports investment, lending, and economic growth. Conversely, hidden risks and poor management can undermine confidence and trigger market instability. Maintaining investor confidence is essential for the health of the banking sector. Non-performing loans contribute to systemic risk in the banking sector. If NPLs accumulate across multiple banks, the risk can spread and threaten the stability of the entire system. Systemic risk is difficult to manage and requires coordinated action from regulators, banks, and policymakers. Understanding the link between NPLs and systemic risk is crucial for preventing future crises. Policy coordination is necessary for managing non-performing loans and systemic risk. European institutions, national governments, and regulators must work together to set standards, share information, and respond to emerging threats. Coordination ensures that actions are effective and consistent across countries. It also helps prevent gaps and overlaps in regulation, which can create vulnerabilities. International comparisons reveal differences in how countries manage non-performing loans. Some countries have more effective legal frameworks, faster resolution processes, and stronger regulation. Learning from best practices abroad can help European banks and regulators improve their own systems. Comparing NPL management across countries highlights strengths and weaknesses and supports ongoing reform. Future challenges include new economic risks, changing market conditions, and evolving regulation. Banks must adapt to these challenges by strengthening risk management, improving transparency, and maintaining capital buffers. The ability to respond quickly and effectively will determine the resilience of the European banking system. Ongoing vigilance and adaptation are essential for managing non-performing loans. Technology is playing a growing role in managing non-performing loans. Banks use advanced analytics, artificial intelligence, and digital platforms to monitor loans, detect risks, and streamline resolution processes. Technology improves efficiency, accuracy, and speed, helping banks respond to problems more effectively. The adoption of new technologies is transforming the way banks handle NPLs and manage risk. Non-performing loans affect consumers as well as banks. When banks restrict lending due to high NPL levels, individuals and businesses may find it harder to access credit. This can slow economic growth, reduce investment, and limit opportunities. Understanding the consumer impact of NPLs highlights the importance of effective management and resolution. Businesses are also affected by non-performing loans. When banks face high NPL levels, they may reduce lending to companies, limiting growth and innovation. Small and medium-sized enterprises are particularly vulnerable, as they rely on bank credit to expand and invest. The consequences for business highlight the broader economic impact of NPLs and the need for effective resolution strategies. Governments play a key role in managing non-performing loans. They set regulatory standards, provide support during crises, and coordinate with banks and regulators. Government intervention may be necessary in extreme cases such as bailouts or emergency measures. The role of government is critical for maintaining stability and protecting the economy from the effects of rising NPLs. Public awareness of non-performing loans is important for accountability and transparency. When the public understands the risks and challenges, they can support reforms and demand responsible management. Raising awareness helps build trust in the banking system and encourages policymakers to take action. Effective communication is essential for maintaining public confidence. Academic research provides valuable insights into non-performing loans. Studies examine the causes, consequences, and resolution strategies, helping banks and regulators make informed decisions. Research also highlights the importance of data transparency and risk management. By drawing on academic insights, the banking sector can improve its practices and reduce the risks associated with NPLs. Summary: non-performing loans are a critical issue for European banks. While the system is stronger than it was in 2012, risks remain. Effective management, regulatory oversight, and ongoing reforms are essential for maintaining stability. By understanding NPLs, their impact, and resolution strategies, we can better prepare for future challenges. The outlook depends on continued vigilance, adaptation, and cooperation among all stakeholders. Non-performing loans may not make headlines, but they represent a significant risk for European banking. By staying informed, supporting reforms, and maintaining vigilance, we can help ensure the stability of the financial system. The lessons learned from past crises, combined with ongoing research and innovation, provide a roadmap for managing NPLs and safeguarding Europe's economic future.